here's the deal with Hims and Hers. This was not a clean quarter, and I think that's the most honest way to start this video, because if you only look at the headline numbers, there are definitely things here that should make investors uncomfortable. Revenue growth slowed down a lot, margins got hit, the company went from profitable last year to a pretty large GAAP loss this quarter, and the US business, which is still the core of the company, actually declined year over year. So yeah, I understand why the market might look at this quarter and say, wait a second, is the story breaking? But when we zoom out, I don't think the answer is that simple. Because at the same time, management raised full-year revenue guidance, guided for a pretty strong sequential acceleration in Q2. Free cash flow was still positive, international growth exploded, and the company is clearly trying to reposition itself from a GLP-1-driven story into a much broader consumer healthcare platform. So in this video, I want to walk through Hims, ticker Hims, what happened this quarter, why the numbers look messy, what I think the market may be missing, and whether the stock still looks interesting around $29.14 per share. And as always, if you enjoy this kind of stock breakdown, hit the like button, subscribe, and drop a comment below with your own take on Hims, because this is one of those names where investors are definitely going to disagree. Now, look at this. Revenue came in at $608.1 million, up only 4% year over year. For most companies, 4% growth is not terrible, but for Hims, that is a massive deceleration. This is a company that grew full-year 2025 revenue by 59%, and Q4 revenue was still growing around 28% year over year. So going from that kind of growth profile to 4% is a real change in the story. And it gets a little more complicated when you break it down. US revenue fell 8% year over year from $578.7 million to $529.9 million. That's not a small number. The US is still the core business, so when that segment declines, investors should absolutely pay attention. The offset was international revenue, which jumped from $7.3 million to $78.2 million. That is 969% growth. Obviously, it is coming off a tiny base, but this is still one of the strongest parts of the quarter. It tells us Hims is no longer just talking about international expansion as some future idea. It is starting to become visible in the numbers. Subscribers also continued to grow. Hims ended the quarter with 2.584 million subscribers, up 9% from last year. So the customer base is still expanding, but here's where it gets less clean. Monthly revenue per average subscriber dropped from $85 to $80, down 6%. For a subscription healthcare platform, I don't love seeing that. The really strong version of the Hims thesis is not just that more people sign up, it is that Hims gets better at monetizing those users over time through more categories, better personalization, more recurring care, and deeper customer relationships. This quarter showed subscriber growth, but weaker monetization. So the business is still growing, the platform is still adding users, but the quality of growth weakened in Q1. Now, the biggest issue in the quarter was margin pressure. Gross margin fell from 73% last year to 65% this quarter. Adjusted gross margin was 70%, but even that was still below the prior year level. Adjusted EBITDA fell from $91.1 million to $44.3 million. Adjusted EBITDA margin dropped from 16% to 7%. And on a GAAP basis, the company went from $49.5 million of net income last year to a $92.1 million net loss this quarter. That is a big swing. So if someone is bearish on the stock after this report, I get it. The bear case is not irrational. You have slower revenue growth, lower ARPU, lower gross margin, lower adjusted EBITDA, and a GAAP loss all happening at the same time. That's a lot to digest, but I also think investors need to understand why this happened. The biggest driver seems to be the strategic pivot in US weight loss. Hims had benefited heavily from GLP-1 demand, but the company is now shifting more toward branded GLP-1 products instead of relying as much on compounded options. And that changes the economics. The way I would frame it is this. The old model may have had better near-term profitability, but it also came with more regulatory and commercial uncertainty. The branded GLP-1 model may be more durable, but it likely carries lower margins and less pricing flexibility. So this quarter was almost like a reset, not a collapse, a reset. And that distinction matters, because if the lower margin structure is permanent and revenue growth keeps slowing, then the stock probably does not deserve a premium valuation. But if this is a transition quarter, and Hims can re-accelerate growth while stabilizing margins, then the long-term thesis is still very much alive. Management is basically asking investors to believe the second version. For Q2, they guided revenue to $680 million to $700 million. Compared to Q1 revenue of $608.1 million, that implies a meaningful sequential acceleration. For the full year, they raised revenue guidance to $2.8 billion to $3.0 billion. The midpoint is $2.9 billion. That's the part bulls are focusing on. Yes, Q1 looked ugly, but management is saying, don't annualize Q1. This is not the new run rate. The business is about to accelerate again. At the same time, adjusted EBITDA guidance for the full year is now $275 million to $350 million. The midpoint is lower than the prior guide. So this is not a perfect guidance raise, revenue outlook improved, but profitability expectations got weaker. That is the trade-off. More growth, lower near-term margins. This is where the investment debate really sits. Is Hims becoming a larger, more durable healthcare platform, or is it just replacing high-margin growth with lower-margin growth? Because those are very different stocks. Now, one thing I do like is that free cash flow remained positive. Hims generated $53 million of free cash flow in the quarter, slightly up from $50.1 million last year. That matters because even with the GAAP loss, this is not a company that is currently burning cash at the free cash flow level. But I wouldn't overstate it either. The cash flow was helped by working capital movements, including a large increase in accounts payable. So it is positive, but not perfectly clean. The balance sheet is also fine, but not risk-free. Hims had about $222.3 million of cash and equivalents, plus $528.6 million of short-term investments. So combined liquidity was around $750.9 million, but the company also had $974.1 million of convertible senior notes. So this is not some pristine net cash story anymore. The business has enough liquidity, but the debt is meaningful, especially as the company keeps investing and pursuing acquisitions. And that brings us to Eucalyptus. Hims announced it would acquire Australian digital health company Eucalyptus for up to $1.15 billion. Strategically, I understand the move. Eucalyptus gives Hims exposure to Australia, Japan, the UK, Germany, and Canada, and it has served over 775,000 customers. If you believe Hims can become a global consumer health platform, this acquisition makes sense. But it also adds risk. Cross-border healthcare is complicated. Regulations are different. Customer behavior is different, margins may be different, and the deal includes deferred payments and performance-based earnouts through 2029. So I like the ambition, but I would not just assume the integration will be easy. Now, let's talk valuation. At $29.14 per share, Hims has a market cap of around $7.25 billion and an estimated enterprise value of about $7.47 billion. Using the midpoint of 2026 revenue guidance, which is $2.9 billion, the stock trades around 2.6 times forward revenue. That does not look crazy for a company that could keep growing revenue at a strong rate, but on adjusted EBITDA, it trades at roughly 23.9 times 2026 adjusted EBITDA. That is not cheap, especially after adjusted EBITDA just fell sharply in Q1. So the valuation is basically saying this: Hims will get through the GLP-1 disruption, revenue will re-accelerate, international expansion will work, margins will recover, and the company will eventually become a much larger consumer healthcare platform. That is possible. But the stock is not priced for everything to go wrong. This is where the 5-year outlook gets interesting. In the base case, the analysis assumes Hims reaches $6.0 billion of revenue by 2030, with an 18% adjusted EBITDA margin. That would mean $1.08 billion of adjusted EBITDA. Apply a 15 times adjusted EBITDA multiple, and you get an implied enterprise value of about $16.2 billion. With 270 million diluted shares, that works out to around $60 per share. From $29.14 today, that is roughly 106% upside over 5 years, or about a 15% annualized return. That is attractive, but it requires execution. Hims needs Q2 revenue acceleration to actually show up. Gross margin needs to stabilize. The branded GLP-1 model needs to work. International expansion needs to scale without wrecking margins. Eucalyptus needs to integrate well, and dilution needs to stay under control. In the bull case, Hims gets to $7.0 billion of revenue by 2030, reaches a 21% adjusted EBITDA margin, and the market gives it an 18 times adjusted EBITDA multiple. That gets you to around $96 per share. That would be about 229% upside. That is the dream scenario. Hims becomes a real global consumer health platform, not just a telehealth company that had a great GLP-1 cycle. The bear case is also worth taking seriously. In that scenario, revenue only reaches $4.0 billion by 2030, adjusted EBITDA margin reaches just 10%, and the multiple compresses to 10 times adjusted EBITDA. That gets you to around $15 per share. That is about 49% downside. And what I like about that bear case is that it does not assume Hims disappears. It just assumes the business is real, but less special than bulls hoped. Growth slows, margins disappoint, and the market stops paying a premium multiple. That is a very possible outcome. So where do I land? I would call Hims neutral to bullish, but definitely high risk. The long-term story is still compelling. I like the consumer healthcare platform idea. I like the recurring subscription model. I like the international optionality. I like that free cash flow is still positive. And I think the company may be making the right long-term decision by moving toward a more durable branded GLP-1 strategy, but Q1 raised the burden of proof. This is not a low-risk compounder yet. Revenue growth slowed to 4%. US revenue declined, ARPU fell. Gross margin compressed. Adjusted EBITDA was cut in half. GAAP profitability swung deeply negative. You cannot just wave that away. The next 2 to 4 quarters matter a lot. If revenue re-accelerates and margins stabilize, this quarter may look like a messy but necessary transition. If margins stay under pressure and US growth remains weak, then the stock probably deserves a lower multiple. So my final view is this. Hims is a high-risk, high-reward platform stock at today's valuation. It can still work over 5 years if management executes, but investors need to be honest about the risk. The upside is real, the bear case is real too, and that's what makes the stock interesting. If you enjoyed this breakdown, make sure to like the video, subscribe for more stock analysis, and comment below with your take. Do you think Hims is building the next major consumer health platform, or is the market still underestimating the GLP-1 and margin risk?